So I first thing what I did was I actually do like a first half year review. I look at what are the REITs price that go up, what the REITs price that come down, and from there see whether I can actually get any learnings or not. So you can see that first half is not very fantastic. So out of how many REITs? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. About 20 REITs. Only we have 1, 2, 3, 4, 5, 6. The price go up, the rest all come down. Okay. So it's sometimes good to study them to see why the price go up, why the price come down. Then from there, see whether we can get some learning. So in fact, this period we have more downs than up. So the up one, I decided to only look at capital DC to understand why, because this one is the more significant at 10%. The rest, if you ask me, is just normal range, range bound. Okay, may not have very specific reason. So I'll be wondering, hey, how come 10%? Then down one, same thing. I only look at those that is went down more than 10%. More than 10% down to see, hey, what actually caused them? What are things to look out for to prevent myself buying them at high price. Okay. So let's look at Capital DC REIT first. So you can see that number one, okay, Capital DC, okay, past 1 year it went up. So this is Jan, after that it actually went up. But from a longer perspective, from a 5 perspective, of course, the price actually came down. Came down. So that is what it is. Yeah. So probably, one reason that it may be bouncing up. So the question when I see this is, hey, is it finally bottoming out? Is this REIT finally bottoming? So it actually came down a long way. Is it finally time that it hit the bottom, then should go back all the way up? So that was my hypothesis when I tried to dig further. So how do I actually know whether is it bottom? So of course, the price is related to the income. So for Keppel REIT, it's actually quite interesting. Okay, I didn't highlight, sorry. You can see that the revenue has actually went up quite sharply. 11% is actually quite significant. Either compared to the previous half or either that is year on year. So went up by 11% is actually quite significant. Okay, so if you look at it, compared previous half went up by 12. And the DPU is actually coming up. So yes, it seems like Keppel DC REITs potentially is bottoming up. Went up because allowed to open another. Okay, that is probably maybe just one of the reason. Maybe that's one of the reason. Yeah, thank you so much for sharing. Okay, so okay, but if you look at overall, it can potentially, because Keppel DC REIT has its fair share of troubles. So by the way, we actually did, Keppel DC REIT quite recently. Later, I can show you the link. You all can actually read more. It has its fair share of trouble. And it seems like potentially, it is actually improving. Of course, one one half year may not see it. Okay. If you want, can confirm to next half year to see that is it indeed that is coming back up. But of course, by that time, the price also would have moved up. Unfortunately, they don't do Q on quarter results. So, but if you ask me, potentially it may has bottomed out. In terms of the DPU, also same story. You can see, the dividend has, in terms of dividend per share, has came down, and it may seems that it is coming back up. Okay, coming back up. So if you have, if any of you Keppel DC fan out there, probably, of course, it's not conclusive. But it probably maybe that Keppel DC finally is out of its woods. Finally is bottoming out. Okay. For those who are interested, maybe can take a look lah. Okay. So it seems that the income pattern can support the what do you call it? The dividend pattern can support. And thank you, Kate Huan, from sharing. Um, okay, I'm not too sure whether that is the significant point, but yep, maybe he's going to open another one. Okay. But generally speaking, it seems that it's out of the woods. So finally, if you actually look at it, the peak was about $3. Now come to about $2. It seems to have found the bottom, or at least this is my observation. Okay, that's why I bounced up. Okay, but if you were to ask me, will I actually buy Keppel REIT at this point in time? Personally, I'm not so keen because the current yield is only 4.17%. So at this point in time, I can find REITs that give me at least 5%. So I won't be focused on this. Okay, or maybe at least not now. This is not my top choice. If you ask me long-term prospect for this REIT is actually quite good. So given that data center, the demand is actually still strong. Okay. End of the day, my funds are limited. So if you ask me, buying something that high potential growth, but currently 4.17 yield versus something that give me more than 5%, it's a personal preference thing. I will actually go for the one that is higher yield. Okay. I rather like what they call a bird, one bird in hand, better than two birds in the bush. So that's me. That's me. No right or wrong. Okay. So I have this YouTube link here. We have, if you want a detailed analysis, when I talk about they were into some trouble, what is it? You can actually go to this link. Let me see, where's the chat? Okay, so of course, you will also get the video. Then if you like, you also get the video with this link, so you can also access the link from there. Okay, so conclusion for this, why it go up? I think high chance it's bottom up. So for Keppel DC REIT fan, it's time for you to pay attention. Is the trouble over? Okay, I think just one half year may not be good enough. If you want to be more definite, you may want to wait Wait for the next half year. But of course, by then, the price may already move So that is a difficult part Okay, so if you want my opinion, I don't buy. My guess is the next half year it will continue to go up given that interest rate is coming down, but it's anybody's guess. Oh yes, for those who are not in the chat group, I have sent out an email. Please reply the email with your phone number. Okay. Please reply the email. Thank you so much. SHQ. Yeah, I'm not too sure. Okay, but we'll take a look. Okay, so Louis, if you can just drop me an email with your phone number so that I can add you in. So for those who are not in the chat group yet, please send me an email. I hopefully by now you have my email. Okay, with the phone number. Okay. Thank you so much. Great. Okay, next, we'll look at those that came down. See, is there like a common pattern why it come down? So we will be looking at this for Mapletree, CDL, Mapletree Logistic, and CapitaLand China. So why it came down? Is it going to go down? Is it a good chance? Okay, let's take a look. Okay, Mapletree Pan Asia, you can see it actually came down quite a bit. Okay, almost 10%. If you ask me, that's quite huge. If we look at the DPU, okay, the DPU actually came down. The revenue actually up actually. MPI also up. And yet, okay, the DPU came down lah. Okay, but generally speaking, actually NPI up is actually quite good thing. So one of the main reason, or in fact, one of the pattern I see that it came down is actually this. Okay, remember my test. So aggregate leverage ratio to pass my test. What is the criteria? Anyone can help me here? To pass my less than 40%. So of course, this one didn't make it. Then after that, interest cover ratio to pass my test, what's the criteria? Interest cover ratio. Okay, what about 3 times more? Or okay, more than 3. Thank you so much. More than 3. Okay, so this one obviously it failed. Okay, so that's why I think at this period whereby interest rate is high, for those that fail my test are still being hit. So the point I'm trying to say here is that that's why I'm actually still avoiding stocks that avoiding REITs that fail my test. Okay. So this one reason. I think the second reason is why it actually dropped is because it is actually removed from an index. Okay, there's actually this thing called the MSCI index. Apparently, it's actually quite a prominent benchmark index. Okay, yeah, key market benchmark. MICI. So this REIT is actually MICI Singapore Index. Okay, so this REIT was actually taken out. So this is another reason that contribute to the fall. Okay, why once the stock got taken out, the price will drop? Okay, because okay, understand this. There's actually a lot of index investor now. Okay, people just invest in index. So of course, if let's say this REIT is actually still in index, right, and then of course people will invest. Okay, so if this REIT is actually not index, then of course it'll be affected. So you can see that yep, once this is out of the index, it actually has a drop. So the point I'm trying to say here is this: if let's say it's actually due to this, that means fundamentally, this REIT is actually still quite strong. Okay, but unfortunately, it didn't pass my test. Okay, there's a REIT that the range that criteria is I set one, nothing to do with government. This is my own personal criteria lah. So it's a benchmark for me to see whether are they taking a lot of debt or not. Okay, it's subjective, but so far it's been helpful lah. Okay, basically if you follow my rule, you would have avoided this REIT and then you won't suffer from the drop lah. So I think what I'm trying to say here is this. In fact, this one has proven that my criteria has worked lah. If not because of this criteria, I may have actually bought, earlier. Then I would have suffered that 10% drop in price. Okay, if you already bought, again, like I said, you see, very good at this. You see, now this is, you are mixing up already. So are you a trader or income investor? Okay, when you buy this, are you there for dividends or are you there to buy and sell? Okay, that is exactly what I mean. That's exactly what I mean. Okay. So if you have already bought it, then your line of thought is going to be a bit different. Okay, then the question is, once you bought it, right? The question is, do you think that it can continue to give dividends? The only reason why you sell is, basically you believe that it cannot give you dividend anymore. Okay, so I would only, if let's say I own this, the only reason why I would sell is I have doubts that it cannot give me dividend anymore. Okay, which I don't think so lah. They by the way, they have their own things like Vivo City. Vivo City is theirs. And and of course they are at risk of bankrupt or cannot pay off the debt, which again I don't think so lah. Okay. So as an income investor, thank you so much. This a lot of people like ask me, so how I want to sell now? Hey, hello, you're income investor or are you a trader? So be very clear of your game plan. So if I own it, if I believe that the property are still good, if I don't think that they will bankrupt, yes, it failed the test, but it's not like they will bankrupt. Okay. Then I'll still keep it now. Usually when a company stock price fall, it means that this is not good. Okay, so that's why you have to understand, like for example, in this case, what we recognize is that the price drop is because it was being kicked out of the index. So fundamentally, things hasn't changed very much. Okay, so I wouldn't agree with your statement. I think your statement is a bit too generic. We have to look at it from case by case basis. Okay. Okay, so again, I think more interesting question. So would I buy it or not? So let's look at the dividend. You can see that the dividend drop actually quite drastic. Okay. Then it actually failed my two tests. Dividend yield 6.6%, also not say super attractive. So basically it's not worthwhile for me to take the risk. So by the way, so for this REIT, it failed my tests. Still drop. Okay, this one I'm not so worried because eventually, let's say interest rate come down, it will come back up lah. That's my sense. But now dividend yield only 6.6%. Does it compensate enough for me to take the risk? I don't think so lah. Okay. When we invest in index, the money will go into companies in the index. So it's indirect lah, indirect. Okay, so let's say for those who are those companies that sell index funds. Okay, so usually it's you sell index funds. And if the way they do it is really what they call it plain vanilla. Okay, yeah. Then if they want to raise more funds in particular index funds, then they will actually use the money to go and buy the underlying instrument. But of course, there are different ways to create index funds right now. Okay, so this is for Maple Tree Pan Asia Commercial Trust. Two reasons why it came down. One is I believe it's because it failed my test. Can not say because it failed my test, but because the loan is actually quite high, okay, based on my benchmark. And the second reason, it was actually taken out from the MSCI index. Okay. Okay, CDL. CDL also have quite significant drop. Let's see. CDL dropped by 17%. 17%. And the only reason why I can find it drop is because so again you can see the revenue actually went up. MP actually went up. The total return actually went up. Okay, so the only reason why I can see why it dropped is because the interest cover ratio. Okay. So all this is a sign that they are paying very high interest rate right now. They are being hit by the increase in interest rate to a very significant level. Oh. So yeah, that is in fact the only reason why I can see it drop so much. So again, that's why I'm so glad that I applied that rule, whereby I have this financial test whereby if you fail my test, I better don't buy. Again, if not, I would have actually suffered that loss. 17% is actually quite hefty. So assuming I only get a dividend yield of 6.2%, I need 3 years dividend, then can cover back. Okay. So whether to buy now, again, dividend yield 6.2%, I don't think it's so far for me to take the risk. Or either that, okay, my point here is this, it's always relative. If I have better things to buy, then why do I actually want to take this risk? Okay, if I can actually buy a REIT that give me 6% and yet, pass my financial test, why don't I do that? Okay. Okay, Maple Tree Logistic Trusts. This one actually dropped quite badly. Let's see. Actually dropped by 20%. Okay, 171 to 16136. Okay. What are the potential reason for the drop? Let's see. Can you see the revenue actually came down? MPI came down and the DPU came down. Okay, it came down quite sharply. So of course the performance didn't do well. I think that's one reason for the drop. However, if you actually compare quarter to quarter, actually it's actually not that bad. Okay, you can see it's actually not that bad. This one up, this one up. Okay, DPU down, but not so sharp. But at least the net property income is actually not so bad. So, I don't know. It seems like down 20% is a bit too much. Given that the revenue is up, the MPI is up. Okay, so if you ask me, very likely. Okay, and if you actually look at the ratios, okay, now maybe you can help me. Did Maple Tree Logistics Trust, they pass or fail my test? Do they pass or fail my test? Pass. Thank you so much. So maybe it could be that, is oversold. And I only can trace back to this. Okay, again, it was actually removed from the index. That means fundamentally, this REIT is okay. It's just that it's actually being taken out from the index. That is why it caused a drop. Okay. So if you ask me, Maple Tree Logic Trust 6.6% yield, if you ask me, can consider given that it passed my financial test. And the reason it dropped, okay, probably not so much about for the REITs itself, okay, but rather because of external factors like being taken out MCI index. 6.6% is actually quite attractive. If you have been following this REIT, generally speaking, you should only expect about 5% from this REIT. So 6% has been actually quite good. Okay. So this exercise, what I'm trying to do here is this number one, to see is there any pattern for those REITs that actually with quite significant price drop. I think one pattern is the financial test, we have to respect it. Okay, we have to respect it. Okay, so understand this. When I think of all these tests, like leverage must be more or less than 40%, interest cover more than 3, it's actually not my own personal test. Not I suddenly think about it. So basically, these are the things that the analysts look at it as well. Okay. And all the analysts will all go through the same course, all of us think same way. And by the way, like REITs is actually one of the instrument that is most bought by institution. So if there's enough analysts like me, I think that less than more than 40% no good. Interest cover more than less than 3 no good. Then they also don't have to buy. Then of course price will drop. Okay, so there's certain logic behind all these tests. Okay, so it's not that I personally created it. I learned from the textbook. This textbook is the same textbook as every analyst. Okay. So in this case, so that's one. We want to respect that. The second thing maybe is to see whether is there opportunity. If you ask me, for those of course who want to take a bit of risk, I think this one can be quite interesting to look at. Okay, yep, good. Someone actually share something. Lower rates persist among renew. Okay. Negative rental reversion in China. Okay, thank you so much. So of course, yes, the other reason could be the China, but I have actually take a look at so China portfolio is about 30%. 30%. So to which is own, to which is own. Um how should I put it? Because why am I not so super concerned about the China one is, I mean, China has been down for the longest time. China has been in what do you call that? Bad shape for a very long time. And yet you can see that the revenue seems to be picking up already. Can you see? MPS picking up based on quarter to quarter. Yeah, year on year, it actually still down. But it seems like there again, same story maybe a chance that it already bottom out. Okay. So yep, to which his own. For those who willing to take a bit more risk, can consider. For those who actually want something more definite, yeah, then of course, yes, there are actually still other things to look at. Okay. But this exercise, these are some things that this exercise have floated up. But really, really, thank you so much for sharing. I believe the China risk is significant. I don't deny that. So I would balance this versus look at China one versus that number. If let's say, for example, next quarter, this one still go up, then I'm not so worried about the China because the China part is only 30% of the portfolio. Okay, lastly, CapitaLand China Trust. This one is the one that suffered the most. It actually went down by, let's see, 23%. Okay, 23%. Okay, let's see what could be the reason. Okay, you can see that the revenue drop, MPI drop compared with last, for MPI, net profit income compared with last half year seems to be okay. And the DPU also drop. Okay, DPU also drop. If I look at from the dividend perspective, you can see that 21, 22, 23, it seems to still continue drop. I have no sense of the bottom yet. Okay, unlike for example, Kappa DC, you can see that there's a turn coming. This one actually still continue to drop. So I'm definitely quite uncomfortable. So China, as you all know, is bad. Okay, so the difference between this and Mapletree Logistics, Mapletree only 30%, this one is 100% to China. Also, yeah, I wouldn't touch this at this moment. It seems that it may not have reached the bottom yet. Okay, question. So, what I'm trying to do is I actually did like a review for the past 6 months in terms of price, what went up and what came down. Okay, so from that conclusion, number one, Kappa DC. For those who are Kappa DC fan, okay, maybe it's time to actually look at the REIT. It seems that maybe the worst is over. I don't know. Can wait for one quarter or it's time to watch. Okay, that's the first learning point. Second learning point is yes, I think that two ratios actually work quite well. Okay, which is what the gearing ratio must be less than 40%, interest cover must be more than 3. I think work quite well. As we can see, out of the 4, okay, out of the 4, 2 of them I think down because of limit the ratio Because if you limit ratio means that the debt is quite high, the interest cost is actually quite high. Okay. Then if you ask me, Capital China, we still don't know where it's gonna go. Mapletree, probably the main reason for the down is out of the index. That means fundamentally still okay. For the high risk taker, okay, to each his own. You may also want to start looking at it. So that is the conclusion I get from this review. Any questions?